How does sugar carryover stock affect sugar prices? Imagine walking into a grocery store and seeing shelves packed with sugar, or maybe noticing they are nearly empty. What you see is influenced by how much sugar is stored from previous harvests. This stored sugar is called carryover stock. It's the leftover amount of sugar held by producers, processors, refiners, and even government agencies at the end of a year or harvest season. Think of it as a safety net that helps balance supply and demand over time. When there is a large amount of sugar stored, it acts like a cushion. This extra supply means there's less chance of shortages, which usually pushes prices down. On the other hand, if carryover stocks are low, it signals that supply is tight. This scarcity can cause prices to rise because buyers are competing for limited sugar. Market expectations also play a role. Futures contracts are agreements to buy or sell sugar at a set price for future delivery. When carryover stocks are high, futures prices tend to be higher than current prices, creating a situation called contango. This reflects the idea that there's plenty of sugar stored, so prices are expected to stay stable or fall. Conversely, low stocks can lead to backwardation, where futures prices are lower than the current spot price, indicating a sense of urgency and scarcity. Producers and refiners watch carryover stocks closely. If stocks are high, they might decide to plant less sugarcane or process less sugar to avoid oversupply. This reduction can help support prices later on. When stocks are low, they might increase production to meet demand, which could eventually bring prices down again. Other factors also influence how carryover stocks impact prices. For example, if the US dollar weakens, sugar prices often rise because it becomes cheaper for other countries to buy US sugar. Rising oil prices can boost ethanol demand from sugar cane, reducing the amount of sugar available for food and thus supporting prices. Investors keep a close eye on carryover stock levels because they give clues about future price movements. High stocks usually mean prices will stay low or fall, while low stocks suggest prices could rise. Combining this information with weather forecasts, currency trends, and global demand helps investors decide when to buy or sell sugar futures. In simple terms, sugar carryover stock is a key indicator of market health. When stocks are high, prices tend to drop because supply exceeds demand. When stocks are low, prices tend to go up because buyers worry about running out of sugar. Understanding these supply levels helps predict how sugar prices might change and guides smart investment decisions.